Hey, this is Arthur Hill, Chief Technical Strategist at TrendInvestorPro.com. You are tuned into our YouTube channel for our weekly video analysis. If you like this video, please give us a thumbs up and consider subscribing. So today we're going to quantify and compare volatility, and we're going to use an indicator on the Trend Investor Pro Indicator Edge plugin called HighLow Range percent. We'll look at an example of a downtrend with high volatility, SPY, an uptrend with high volatility, the Energy ETF from Deutsche Bank, and then we'll look at the Gold ETF because it is in an uptrend, but you'll see that volatility is relative. In other words, this HighLow Range percent, the numbers you see for SPY and DBE don't correlate to what you see for gold. Gold has its own threshold for what is considered high volatility. So let's hit these charts. So I'll show you where you can find this indicator. I'm on Stock Charts ACP, and if you go down to the bottom right, there you're going to see a plugin icon. And if you open that, you can see all the plugins available. And there's the Trend Investor Pro Indicator Edge plugin. And I've got two indicators here. I've got HighLow Range percent, and I've got the trend composite. So I'm looking to do two things. I'm looking to identify the trend and the level of volatility based on this HighLow Range percent. And I'll show you that formula in a minute. If I go over to the upper left on the chart settings, there you can see HighLow Range percent. And what I'm doing is it's just a 20-period average of the HighLow range as a percentage of the HighLow range. And you can put a moving average on that. So if I change signal periods to 10, you can see there's a moving average. So you can see when that range is expanding, volatility is expanding, it's rising, and then declining, and then expanding. But I mostly look at absolute levels. So I leave that moving average or that signal at 1. And then the reference is the horizontal line that you see there. So everything above that reference line is red, and that's when I consider volatility above average and a bit of a warning. Now, this reference line is going to change depending on the ETF or stock you're using, because some stocks and ETFs have higher volatility. For instance, when we get to energy, you're going to see that the volatility threshold is going to be higher, and I'm going to have to change that reference line. So here's just a quick formula of HighLow Range percent. You can see it's the high minus the low, and then I take the average of the high and low, and I divide it by that to get the percentage. And so basically, if you have 110 for the high, 100 for the low, that's going to be 10. And then the average of those two is going to be 105. And you divide 10 by 105, and you're going to get 9.5%. So you can see that's some pretty good volatility there. Now, if we go back to this SPY chart, you can see the reason I'm using the high-low range. You can see we had this spike low here, and that was the day of the invasion when Russia invaded Ukraine, and we had that seriously big gap down on the open and then closed up. Well, I'm looking for this range to quantify volatility. So on this indicator window, basically I've got a 20-period moving average of each day's HighLow Range percent. And you can see here that during this uptrend from April until September, basically, the HighLow Range percent, the average, the 20-day average, got above 1% 3 times. And that's a relatively low volatility, low volatile volatility environment. And that's bullish. And then you can see we had the decline and volatility picked up. And then we get the breakout there, and volatility subsides again as we move higher. But then look in December here. In December, we had volatility above average as we were hitting new highs. And that's because we had a surge, we had a dip, we had a surge. And these were pretty big, wide-ranging days. I mean, that's what the HighLow range quantifies. And so that's kind of a warning that, hey, volatility, it's the highest it's been since the last corrective period, if you will, since March. And you can see here, then it shot up there in January to its highest level in a while. I can back this chart up and we can see how long and get volatility into perspective here. So we had some volatility when we were chopping around here going up in the early part of 2021. But then we get this surge in volatility and we get the trend composite turning bearish. And that is a bearish combination because volatility tends to be more bearish than bullish. And so if you're getting a volatility surge and you're breaking down, that means you're getting a substantial decline and you're reversing the trend here because the trend composite is red. And so if I back this chart out even more, we can see there's COVID. All right, we had this huge volatility expansion. I'll put the crosshair on, and you can see here that we had this huge volatility expansion in late February it started and into early March, and the trend composite turned bearish on March 2nd, which is where the crosshair is, and we're also having a surge in volatility. So that was a negative combination. And then volatility started to subside here, you can see. And it stayed around for a while. I mean, there was some yoke here because, you went down and then you went way back up. You completely recaptured all the losses. And so that's why volatility kind of remained above average. During this consolidation, we had above average volatility, and then we broke out of it. But we were in an uptrend. So if you're in an uptrend and you still got above average volatility, you don't worry about it so much unless you get this spike that signals you're going parabolic, which is what happened with oil and energy. And we're going to look at that next. So here's the energy ETF, and you can see I've got high-low range percent and all the bars are red. And that's because I've got my reference line at 1, which is where it was for the S&P 500 SPDR. But oil is a lot more volatile than the S&P. More likely, I need to put it around 2 to see some above average volatility. And so I can go to the indicator settings and I can click on the indicator and set the reference to 2. And then I can close it and you can see this will change. Now, because I'm taking a 20-day moving average and moving averages lag, there's going to be a little bit of lag in the indicator. But you can see we had this volatility uptick here in late November, and that pushed it above average. And it took a while for those high volatility days to be erased from the moving average after 20 days. And then it came down as we started breaking out in late December there. So that was a bullish signal because we were in an uptrend. Trend composite was still bullish. And then you can see here volatility started expanding in March. And that coincided with this big surge here. And the 20-day moving average, and I'll put the crosshair back on, you can see that when we got above here, the 20-day moving average was at 2.63%. And that was the highest level in over a year. And that told you we were going parabolic. But of course, you didn't need an indicator to tell you that. This surge here is parabolic. And when you get a parabolic surge, it's dangerous. Now, I'm not going to say it's absolutely bearish because you never know when a parabolic move is going to end. And you can see this one ended really quick because you had a parabolic surge and then you came all the way back down almost to where it started. But the fact that you got this expansion in volatility said, hey, things are getting a little bit out of hand. You might want to be a little careful. I mean, you don't want to be adding to positions when volatility is surging and you're at this in this parabolic move. Now that we've come all the way back down, nothing has changed on oil as far as the long-term chart is concerned. I mean, there is clearly an uptrend here, and we're just reverting back to the mean. You know, this is almost a mean line, almost like a linear regression, and we're coming back to that mean. We're coming back to a support zone. So oil is still long-term bearish despite this surge, this pop and drop. It just went parabolic, and that was too much too fast. So before we look at gold, a couple of points to keep in mind with volatility. Volatility is relative, so what may be extreme volatility for SPY is not necessarily going to be extreme volatility for DBE, the energy ETF. In general, volatility is more negative than positive, more bearish than bullish. And that volatility surge after an advance, if you're in an uptrend and you're at a 52-week high, and then you get this surge in volatility as you advance, you got to be careful because that means you're going parabolic. And what do you do with volatility? Well, it's very hard to trade, obviously, and that usually means higher levels of cash. And so because SPY is in a downtrend and we have higher levels of volatility, that probably means higher levels of cash are warranted, less risk. And also smaller positions are usually warranted when volatility is high because that means risk in each position is high. So what's new at trendinvestorpro.com? Well, we've been keeping very busy with the volatility, but I'm still basing all of my decisions on what the charts and the breadth models are telling us. This is the market regime page. And currently we're in a bearish market regime, have been since the middle of February. I've got an ETF signal table for trend signals and ranking performance. And this week we covered volatility because even though we have this big volatility in metals, in gold, in oil, it doesn't change the long-term trends that were out there. And it's the same thing with SPY. SPY was already in a long-term downtrend, and we're just getting this volatility within an existing trend. So we don't see any trend changes, but we've seen some pullbacks to some potential support levels in copper and in base metals and silver and gold and oil. And so those were highlighted in the report on Tuesday. So check that out if you're interested. And finally, we have gold, which went parabolic, doing the old pop and drop. And again, I need to adjust my reference line back to 1% for gold so we can see when it's getting above average volatility. And if we look on this chart, we can see that gold did turn bullish there in mid-November with this breakout. If we put some lines on this chart, we can see that it was a kind of a wedge correction thingy because basically at a surge, a long correction, you held above this low here from March, April, and you broke out. Had a pretty hard throwback, but then turned up again. So this was a strong move, and then it went parabolic here. And then you had the sharp reversal, but it doesn't change the long-term picture. The long-term picture is still bullish here. You can see that you broke above this high, and you're coming back to this high, and you can see there's a previous high. So this is kind of a consolidation. We're coming into a potential support zone, and if you put your Fibonacci retracements on, you're going to get about a 50% retracement line here. But the point also is that you can see that this high-low percent indicator started turning up sharply. So here I'll put the crosshairs on again, and you can see that when gold was surging above 190, this was at a multi-month high. And so when you're getting at a multi-month high in the high-low range percent, that means volatility is high. They're going parabolic. You got to be careful. But the fact that we did the pop and drop doesn't change my opinion on gold longer term because the longer term trend is still up. So if you'd like to know more about trendinvestorpro.com, you can click on the link in the description below. If you like this video, please give us a thumbs up and consider subscribing. Thanks again for tuning in, and I'll talk to you again next week. Have a great day.